Hey, welcome back. My name is James Johnson. My expertise lies in retirement and estate planning. And today, what I'm going to talk to you about is policy loans inside of your maximum funded life insurance policy. Now, here's the thing. If you came here to learn about life insurance, you're at the wrong place, because if you don't understand life insurance, you're certainly not going to understand this. So you should probably stop, go back, look into one of the videos on how to build a maximum funded life insurance policy. This is for those people that understand what that's all about, and this is to understand how you can use policy loans inside of your policy to maximize your future going forward. So if you've got this far, you're pretty familiar with the PEM model, which is your personal economic model, and how we would actually build the life insurance policy. So we would go over here over time, we would build our life insurance policy up, and what we have now is we have a cash value inside of our policy and a death benefit. Now, there are three ways to remove money from a life insurance policy. There is the sad way. Well, the sad way is relatively simple. What you'll find is that if you were to die, your heirs get this number here. So they get everything inside of this bucket up to the full amount, tax-free, going forward. That is the sad way. And believe me, I'll do my very best to make your heirs look sad when I hand them a check for $1 million. Now, that's a joke, but the reality is that it is sad, but it's there for that purpose, and that's to protect your heirs. Now, there is what we would call the dumb way. And the dumb way is where we actually withdraw money, and that's merely a word. So we're going to withdraw money from our tank. It's going to come down here. It's going to come to this tax filter, pass that tax filter, and then be consumed and gone forever. Now, when we go and we borrow money, or we actually withdraw money, what happens is our account goes like this. Now, there's a couple of downsides to withdrawing money. And the first downside is that if we withdraw money, we can only put it back at our 7-pay or our TAMRA. We cannot put it all back at once. So if we take $500,000 out of this policy, it's highly likely it would take us 5 years to put it back in. And if we withdraw money and we withdraw beyond our basis, any money that we withdraw beyond our basis is going to get hit with this tax down here at ordinary income taxes. So there's the smart way to remove money from a policy, and the smart way to remove money from a policy is we're always going to borrow money. Now, when you borrow money from a policy, you're not going to borrow your money, which is this green money over here. You're going to borrow the insurance company's money, and you're going to use your money as the collateral capacity to borrow their money. So let's take a look at what that would actually look like going forward. So let's say we need some money. We're going to buy a house. We're going to buy a car. We're going to put our kids through college. We have some medical bills to pay. Whatever need that we have for it, the insurance company's never going to ask us what we need the money for. They're never going to grant us permission on anything other than the fact that you have a collateral capacity to borrow the money. But let's just say, for example, that the car that you want to buy has a 2% interest rate. Okay? And they're going to loan you the car, or loan the money to buy the car at 2% interest rate. Well, but I have this policy built up out over here, and I could actually go out here and I could take that money up to 85% of that cash value that's inside that policy, and I could use that to buy the car. And the way I would do that is, as I stated, I could go out here to the insurance company and I could take a policy loan based on the collateralization of my cash value. So let's talk about that car for a second. It's a 2% loan. That's a pretty good rate. But what happens if we don't make the car payment? Well, the problem then is that they take the car. So if I go and I borrow from the insurance company, typically the rate that I'm going to borrow from the insurance company, depending upon fixed rates and indexed rates and all that type of stuff, but typically this rate is going to be a guaranteed rate of about 5%. Now, you'll have to check and see what that rate is at the time when you go to borrow the money. You could have a variable rate, you could have a fixed rate, but whatever the case may be, is more often than not, we're performing at a better rate over here. So we're performing over here at rates of average, say 7%, and we're borrowing at 5, that means we actually have a positive arbitrage of 2%. So the reality is this account went up by 7%, this account went up by 5, the difference between there is 2%. And incidentally, we don't have to pay the loan back. The only time we have to pay the loan back inside of our insurance policy is at whatever point we say give us all of our money or we die. And at whatever point that is, now if we were to die, our heirs would get the difference between this number and this number. And if we said give us all of our money, we would get the difference between this number and this number. So at that point, the loan would be paid back. And this is one of the greatest things about borrowing the money. They're not going to ask us or grant us permission. They're just going to simply do it based on the fact that we have the collateral capacity to be there. So loan payments are made to the insurance company when they're paid back. They're not made into our policy, while our policies might still be getting funded and it's growing the entire time. So with that being said, the internal growth is additional contributions increases the collateral capacity. Now, let's say that we wanted to borrow this money for a different reason. Let's say that we wanted to go out and we wanted to leverage this money. So for an example, we get out here and it turns out that we've built our policy up, but all of a sudden, let's say the market's dropped and our favorite stock is down 40% and we know it's going to come back considerably. Well, we've got this money that's over here growing tax-free inside of our policy over here. It's getting most of the gains of the market. It's not participating in the losses, but we want to get a better rate of return out of it. So what we're going to do here is we're going to go borrow that money, and then we're going to reinvest the money. So you can see over here in our risk tank, we're going to reinvest that money. Now, once we've done that, we decide we've made whatever money we're going to make. We may want to pay back that loan, and at which point when we pay back that loan, our money is also continuing to grow over here, possibly. And we end up with money over here and money over here, and we actually grew it in 2 places at once. This is done buying houses, doing stock purchases, paying for college. I mean, the list goes on and on and on of all the different things that you could do with this thing. One of the things that I hear quite frequently is I have a 529 plan. Well, the problem with a 529 plan is once you drain it, you can't put it back. And the greatest thing about this life insurance policy is we can put it back. Now, some things you should understand about borrowing money from your life insurance policy is you have a guaranteed access to the cash value from your policies. You never are asked for the purpose of the loan. Your loan does not show up on your credit report. You have a non-structured payments, meaning you don't have to pay it back at all. Loans are collateralized against your cash value. You borrow against your cash value, not from it. Policy loans do not require you drain your tank. Remember the 529. Your cash value continues to grow with or without a loan. Loan payments are made in the insurance company and not your policy. Interest on loan payments may be deductible as an investment expense. In the event of your death, your loan balance is subtracted from your face amount. So, as I told you, a life insurance policy is a wonderful tool. Now, it takes some time to build it, and there are some bad things to know about it. But when it gets down to the policy loans, once you figure this stuff out, you begin to wonder why you didn't do this way earlier in life. So remember, live like you're going to die tomorrow and plan like you're going to live forever, because you just might. And be certain to reach out to us at any time if you have any further questions on these subjects. Keep smiling and make it a great day.